planning to keep your current home as a rental when you upgrade? Maya has $100,000 that will later help buy her next private home, the new home she will live in. If she keeps it in a genuine offset, she later spends her own cash. If she pays it into the loan and redraws it, she is borrowing that money again for a private purpose. Both paths still end with $600,000 owing. But in our first rental year model, the repay and redraw path leaves $6,331 of interest tied to Maya's private home rather than the rental. Same balance, different debt. Here is why in 4 stops. Before we go further, this is general education, not financial or tax advice. Maya and all figures are illustrative. The result changes with the loan history, ownership, rental timing, and what each borrowing funded. A real case needs a registered tax agent and, where relevant, a licensed advisor. Let's freeze the numbers immediately before Maya moves. She is 38, bought her current home in 2024, still owes $600,000 on the original home loan, and has saved $100,000 for her next private home. For now, the home is not a rental. Maya is simply deciding where the $100,000 will sit. That is all we need at stop 1. One home, one loan, and one pot of cash. Now Maya makes the choice from the title. In the offset path, Maya puts the money into a bank account linked to her home loan. It stays her cash, but the bank calculates interest as though the loan were $500,000. In the repay and redraw path, Maya pays the $100,000 into the loan as an extra repayment. She now owes $500,000. Her app may show $100,000 available to redraw. Before the move, these paths can feel almost identical. In this simplified same rate example, both can be charged interest as though $500,000 is owing, and both appear to leave $100,000 within reach. But they are not the same thing. In the offset, Maya still owns $100,000 of cash. After the extra repayment, that cash has paid off debt. The available redraw is the ability to borrow money again, subject to the lender's terms. That is the point of stop 2. Offset money is still Maya's cash. Paying it into the loan reduces debt. Taking it back out through redraw means borrowing again. Now Maya upgrades. She keeps the old home, advertises it, and makes it genuinely available for tenants. She also needs the $100,000 for her new private home. In the offset path, Maya withdraws and spends her own cash. The old loan remains $600,000. No new money is borrowed from that loan. In the repay and redraw path, Maya starts with a $500,000 loan. She redraws $100,000 and spends that new borrowing on the private home. Her app returns to $600,000 owing. Both loan balances now show $600,000. But only the repay and redraw path contains $100,000 borrowed for Maya's private home. The tax question follows what the borrowed money paid for. The original $600,000 was borrowed to buy Maya's old home. From the date that home is rented or genuinely available for rent, the interest expense on the portion of that original borrowing still owing may be deductible as a rental expense, subject to the full facts. The redrawn $100,000 paid for Maya's new private home. In this simplified example, interest on that new borrowing is private and not deductible as a rental expense. It does not become rental related just because the loan is secured against the old home. The ATO reaches the same conclusion in a closely comparable example. A homeowner makes an extra repayment, later borrows the same amount again through redraw for a new private home, and rents out the old home. Interest on that new borrowing remains private. That is the point of stop 3. The balance tells Maya how much she owes. The money trail tells her what the debt paid for. Now we can put a number on the difference. To isolate this one choice, both paths use the same owner, loan, rate, and repayments. The property is available for rent for the whole 2026 to 27 year. There are no earlier redraws, and the loan has 25 years remaining. For the illustration, we use 6.38% based on the Reserve Bank's June 2026 average for existing investment home loans with principal and interest repayments. It is not a forecast or a rate offered to Maya. Because both paths start the rental year at $600,000, both produce the same $37,988 of first-year interest. Under these tightly controlled assumptions, our model treats all of that interest as potentially deductible rental interest. Maya's actual deduction would depend on her complete facts and the law applying to her. In the repay and redraw path, the same bill is split. $6,331 follows the new private home borrowing rather than the rental. The remainder follows the original home part of the debt. A deduction reduces the income on which tax is calculated. It is not a dollar-for-dollar refund. That $6,331 is the part of the first-year interest bill that is private in one path, but modelled as potentially deductible in the other. The actual tax effect still depends on Maya's full circumstances and the law that applies. That is the point of stop 4. The total interest bill is the same. Its potential tax treatment is not. This is not only a first-year problem. The final loan now contains an original home part and a private home part. Each normal repayment includes interest and principal. The principal part generally pays down both components in the same proportions. For tax allocation purposes, Maya generally cannot choose to treat a normal principal repayment as reducing only the private $100,000 component. Refinancing may separate the two components into different loan accounts, but it cannot change what the money originally bought. Maya therefore needs records showing each redraw and where the money went. Now change one fact. If Maya instead uses a separately traceable redraw to buy an investment expected to produce income, such as dividend-paying shares, interest on that borrowing may be deductible under the full facts. That does not mean she should borrow to invest. It only shows that the use of the new borrowing matters, and her records must still show where the money went. So, offset good, redraw bad is the wrong lesson. The account name does not decide the tax treatment. The use of the new borrowing does. Here is the whole video in 3 lines. Cash in a genuine offset remains separate from the loan. An extra repayment reduces the debt. A later redraw is a new borrowing, and the interest question follows what that new borrowing paid for. The balance tells Maya how much she owes. The money trail tells her what the debt paid for. For Maya, keeping the cash in offset leaves the original $600,000 borrowing untouched, while her own cash funds the new home. Repaying and later redrawing instead replaces $100,000 of that original borrowing with new private debt. That does not make an offset universally better. Its rate, fees, access to cash, Maya's spending discipline, and whether the old home ever becomes a rental still matter. Real loan histories and ownership arrangements are usually messier than this 4-stop example. The personal structure belongs with a registered tax agent, and, where credit or strategy is involved, an appropriately licensed advisor. If clear Australian money explanations with the assumptions left visible are useful, subscribe to The Next Dollar Australia. Thanks for watching.